This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, in the last lecture on statements of cash flows, we went through that full example, produced the full statement. And as I said at the end, the method we'd used is called the indirect method. In that, when we got the cash flows from operating activities, we started with the profit before tax, made various adjustments to end up with the cash generated from operations. Now, I'm about to show you there is an alternative way of arriving at that 142,000. The rest of the statement stays exactly the same, so nothing else changes. It's simply the cash generated from operations. Either we use the indirect method, and that, as you'll see later, is the method that's important for you. Virtually anything in the exam, you'll be tested on this indirect method, and it's the way most businesses use. But there is an alternative way of arriving at the 142,000. That's what I've got to show you now, and it's called the direct method. And it's actually quite sensible, because remember, we need the cash generated from operations. Yet again, we took the profit and then adjusted, increase, decrease to get cash. But the alternative goes straight to it, and it says, if you look at the next page, you can see the basic layout. Why don't we just calculate the cash received from customers we should be able to get that from the computer. How much cash did customers actually pay us? And subtract from it the cash we actually paid out. And you've got to do it under three headings, as you can see. The cash paid to suppliers, you've got to separate out the cash paid to employees, and you've got to show separately the other cash payments. Cash paid for expenses. And that'll give us the cash generated from operations. Whoops. And as I said before, it's just that bit of the statement can change, because once we've got the cash generated from operations, whichever way we've done it, everything else follows exactly as before. So you then subtract the interest paid, dividends paid, tax paid. You then bring in cash flows from investing activities, cash flows from financing activities in exactly the same way. Now, just to show you how it works, we'll look at an example doing it both ways. But as you will see, or as I will explain, the chances of being tested on the direct method are actually very small, but you'll see why afterwards. But have a look at example 2. Gattis has the following statement of profit or loss for the year ended December 2007. So the sales, the revenue, cost of sales, gross profit, expenses, net profit. And I've given you extracts from Gattis' statement of financial position. The inventory, the receivables, the payables. And there's a bit more information below. Expenses include depreciation, bad debts, irrecoverable debts rather, and employment costs. And the second one, during the year we'd sold a non-current asset for 24, which had a book value of 18. Now, we're not going to do a full statement of cash flows, we haven't enough information. We're just required to calculate the cash generated from operations. And we're going to do it both ways. The indirect method, which you should already be happy with from the last lecture, But then I'll do it again using the direct method. So first of all, the indirect method. And what do we do with the indirect method? We take the profit before tax, and we make those two sets of adjustments. We adjust for the non-cash items, and if you look at note 1, expenses included depreciation. So that profit is after depreciation, which is non-cash. We add it back, and the depreciation was 36,000. And as I said in the last lecture, the only other one you're going to see is any profit or loss on sale of non-current assets. Here in note 2, we'd sold an asset for 24. The book value was 18. So there was a profit on sale of 6,000. It was a profit. It's including the profit, we remove it. Incidentally, some people rather want to adjust for irrecoverable debts written off. No, because if you've removed an irrecoverable debt, you haven't had the cash, so there's no problem. That brings us to so far 270. But then we have to adjust for the changes in the working capital. And we've got extracts there. So inventory, there's been an increase in inventory. We've gone up from 140 to 160, an increase of 20,000. More inventory means less cash. There's been an increase in receivables. 235 up to 259, it's gone up by 24,000. More receivables, customers pay later, less cash. And finally, there's been an increase in payables. 138 to 168, an increase of 30,000. And of course, if we're taking longer to pay our suppliers with more cash. And so after adjusting for those, the cash generated from operations got my calculator, 270 minus 20 minus 24 plus 30, 256,000. Now that's all we're asked for here in a full statement. Remember, carries on like before, less interest, dividends, tax paid, and then cash flows from investing activities, cash flows from financing activities. All right, well, that's fine. However, now let me show you the same question, but getting that 256,000 using the direct method. Now, I don't need bits of workings, but if you look on the previous page, we'll need to work out the cash received from customers I'll leave it blank for the moment. We'll do the workings and then fill it in. But we need the cash paid to suppliers. The cash paid to employees. And then the other payments for our expenses. So let's do the workings and see what we get. First of all, cash received from customers. Now I'll do the workings here. Because how can I get it? I know what the revenue was. It was 1.2 million. So those are the sales. Why haven't I received that much cash? Well, at the beginning of the year, I was already owed 235,000. So I'll receive that cash this year. But at the end of the year, I'm still owed 259,000. So that amount of cash hasn't been received. Do a T account if you want. I don't think you need to here. The cash we've had is the cash we were owed from last year, plus whatever we've sold this year, less the cash that hasn't been received this year. In addition, of course, look at note 1. There have been irrecoverable debts removed. If any of those were irrecoverable, well, there's 14,000 cash which hasn't been received. And so the cash received from customers, 1,200 plus 235 minus 259 minus 14 is 1162. There we are. So I hope that's okay. What about cash paid to suppliers? Now here I'm going to have to do workings separately. Sorry, that was the workings from the last lecture. Let me remove it. Because to get the cash paid to suppliers, I'm going to need to know what we bought this year. And how am I going to get to know what we bought this year? We are told the cost of sales. Now remember, the cost of sales is the opening inventory plus the purchases minus the closing inventory. Now I know what the opening inventory was. In 2006 it was 140,000. The purchases are what we're trying to find out. The closing inventory 2007 is 160,000. And so I know what the cost of sales themselves were. From the statement of profit or loss, it's 840,000. Well, I need to work backwards to get what we actually bought. So 840, that was after subtracting closing inventory of 160, which meant, if we go backwards, 9, it must have been 1,000,000. 840 plus 160, that 1,000,000 is the opening inventory plus the purchases, so the purchases must be the difference, which is 860,000. It's the missing figure. The purchases must have been 860, so the cost of sales, opening inventory plus purchases less closing inventory, did come to 840. So that's what we bought, but I need to know what cash we actually paid. Well, again, look at the figures for this year, last year. At the end of last year, we already owed 138,000, so presumably that was paid this year. In addition, we bought another 860, but we haven't paid all the 860. Some of it, 168,000, is still owing. So how much cash did we actually pay? 138 plus 860 minus 168. The cash actually paid is 830,000. So a bit of messing around there. Cost of sales, we can work out what we bought. When we know what we bought, we can work out what the cash paid was. So 830,000. Cash paid to employees, well, we're told that directly. Note 1, employment costs 42,000. And finally, the other payments, the payments for expenses. Well, I'll do the workings for that here. From the statement of profit and loss, the payment, the cost of expenses was 120,000. Why isn't the cash paid? Firstly, if you look at note 1, that includes depreciation of 36,000. Well, 36,000 isn't a cash flow, isn't a cash payment, so remove it from the total payments. The irrecoverable debts of 14. Well, that's not an actual cash payment, and I've dealt with it when I got cash received from customers. The cash we received was 14,000 less than it would have been. So I don't want to include it twice, so I'll take that out of my expenses. Employment costs, 42. Well, we're showing that separately, so I don't want to include that 42 here as well. Take it out. Note 2. During the year, we disposed of a non-current asset for 24, which had a book value of 18. There's a profit of 6,000. And what does it say? It says that profit had been netted off expenses. What it means is, if you have expenses of let's say 100,000, and there's a profit on sale of 6,000, that leaves you with expenses of 100 minus 6, expenses of only 94. Well, profit on sale isn't a cash flow. And so, see what I mean, you see? If it was 100, you had a profit on sale, this is expenses. It gives you 94 as the expense. But the 6 isn't a cash flow, that profit. The true expenses are 6 higher at 100. We need to add on 6,000. And so the other payments, 120 minus 36 minus 14 minus 42 plus 6 is 34,000. And that should leave us with the cash generated again from operations. And let's check and let's hope it comes to the same. 1162 minus 830 minus 42 minus 34, 256,000. Is that what I got before? Yes, it is 256,000. All right, now I went through that fairly quickly. I don't know if you find that easy or messy. However, two things. One is, I have already said, but I must repeat, these are two different ways we can arrive at cash generated from operations. Once we've got that figure, everything else in the statement is exactly the same. It's just two ways of getting that one figure. Secondly, and the reason I'm much less worried about this method, and so should you be, is the accounting standard. This is accounting standard number 7, which gives the layout for the statement of cash flows. It says that if you do choose to use the direct method, you, in practice, you must also have a note showing the direct method. So that will always have to be there, always. It'll either be the first bit of your statement of cash flows, or if we do our statement of cash flows that way, this must also appear, as a note. So for that reason, most businesses just use the indirect method. If you do that, then that's all that's required. And for that reason, almost everything you'd be asked on this in the exam would be on the indirect method. The chances of being asked to do direct method are very small. If they test you at all, it'll probably be just an awareness of what it is, and the fact that direct and indirect obviously both give the same figure. Okay, so that's the end of that chapter.